Welcome to the deep dive, everyone. Today, we're jumping into something super important, something that affects all of us but doesn't always get talked about enough. Personal finance and smart investing, specifically for India.
Exactly.
Whether you're just out of college, already working, or maybe just thinking about getting your finances sorted, we're aiming to give you some clear, actionable takeaways today.
Yeah.
Our mission: cut through the jargon, pull out the practical stuff from our sources, and make managing your money feel, doable.
For you. And it really should feel doable. Financial literacy, it's not just about crunching numbers, is it? It's fundamentally about building security, having options. And what's great today is that these insights are really tailored to the Indian context. You might get some real aha moments.
Okay, let's kick things off with a quick scenario. Picture two friends, Raj and Priya. Both earn, say, $50,000 a month. Raj spends pretty much all of it, paycheck to paycheck. But Priya, she makes it a point to save $15,000 every single month, and she invests it. Fast forward 10 years. Who's better off financially? It seems obvious, right?
Yeah.
But it highlights this isn't just about how much you earn. It's about your mindset towards money. And here's something quite direct from our sources. Apparently, Indians are great savers, but terrible investors.
Ooh, that's a strong statement. And it really matters, that distinction. Saving is vital, yes, step one, but it's only half the battle. To actually grow your wealth, your money needs to start working for you.
Right.
And that needs a couple of key mindset shifts. First, seeing money as a tool, something you control, not the other way around. Second, understanding the sheer power of starting small, but starting now. Honestly, investing just $500 today is genuinely better than planning to invest $5,000 neighbor next year.
That procrastination trap.
Exactly. And the third big thing, maybe the most overlooked, recognizing inflation as this silent enemy eating away at your savings. India's average inflation, it's been around 6% a year. So if your hard-earned savings are just sitting in a bank account earning maybe 3 or 4%, you're actually, you're losing money in terms of what it can buy. Every single year, it quietly shrinks.
That's a sobering thought, losing money while trying to save. So how do we flip that? How do we move from just saving to actually growing it?
It starts with a basic tool, but a powerful one. Budgeting. Think of
Yeah.
it like your financial map, your GPS.
Okay.
And a really useful framework is the classic 50-30-20 rule. We can adapt it a bit for the Indian context.
Right. The 50-30-20. How does that break down for us?
So it's pretty straightforward.
Wow.
50% goes towards your needs. These are the absolute essentials. Rent or your home loan EMI, food, utilities, transport, insurance premiums, minimum loan payments. The must-haves.
Got it. Essentials.
Then 30% is allocated for wants. This is your lifestyle stuff. Eating out, clothes you don't strictly need, maybe Netflix, gym memberships, travel, hobbies, things that make life enjoyable but aren't, critical for survival.
Okay. Needs and wants. What's the last 20%?
That crucial 20% is for savings and investments. This is the engine for your future wealth. It covers building your emergency fund, saving for retirement, investing for specific goals like a house deposit or your kids' education, and paying off debt faster.
Now, you mentioned an Indian twist. What's that about?
Yes, this is interesting. Our sources point out that for many younger Indians, especially those living with family, their essential expenses, the needs, can be much lower than 50%.
True.
This creates a fantastic opportunity. If your needs are lower, you might be able to use something like a 40-20-40 rule. So needs drop to 40%, wants stay at maybe 20%, and you can then ramp up your savings and investments to a really significant 40%.
Wow. 40% going towards building wealth. That could really accelerate things.
Absolutely. It's a huge advantage if your circumstances allow it. And maybe a practical exercise for everyone listening. Take a moment later and think, where did your money actually go last month? Just tracking it for a bit can be incredibly eye-opening.
Yeah, that awareness is step one. Okay, so you've got your budget, you know where money's going. What's the next foundational piece?
Protection. Building that safety net. And that brings us straight to the emergency fund.
The financial airbag.
Exactly. You hope you never need it, but if something unexpected happens, job loss, medical issue, urgent repair, you'll be so glad it's there.
So how big should this airbag be?
Well, it depends on your situation.
Wow.
For a single person, the general advice is about 6 months' worth of essential living expenses.
Okay.
If you're married or have kids or other dependents, you'd want a bigger cushion, maybe 6 to 12 months' worth.
Makes sense.
And if you're a business owner or a freelancer where income might be less predictable, aiming for 12 massive expenses is probably wise.
Right, that's stability. And where should you keep this money? It needs to be safe, but also accessible, right?
Precisely. Safety and liquidity are key. Options include a high-yield savings account, super accessible, but returns are usually modest. Liquid mutual funds. They can offer slightly better returns, and you can typically get the money in a day or two.
Okay.
Or fixed deposits, FDs. They might offer higher returns again, but you need to be careful about penalties if you break them early.
So maybe not all in one place.
That's a great point. A kind of pro tip from the sources. Don't keep it all lumped together. Maybe split it. For instance, keep, say, 2 months' worth of expenses in an easy access savings account for immediate needs.
Right.
And then put the rest into liquid funds or maybe some short-term FDs to potentially earn a bit more. And look, even if that 6 or 12 months figure sounds huge, like 3 lakhs or 5 lakhs, don't get discouraged. Start small. Put aside 10,000, then aim for 25,000. Just build it up gradually.
Brick by brick. Okay. Emergency funds sorted. We're protected. Now, how do we start making our money work a bit harder? Where do we begin with investing?
Right. Moving from protection to growth. We can start with some, let's say, more reliable conservative options first.
Sounds good.
Think fixed deposits, FDs, and bonds. FDs are, familiar territory for many, predictable, currently giving around 6-7% returns. Good for people who are risk-averse or have short-term goals.
The reliable friend, as you said.
Yeah. But an interesting insight is looking beyond FDs to government or corporate bonds. These can sometimes offer slightly better returns, maybe 7-9%, with relatively low risk, too. They can be a good alternative, even for those skeptical about the stock market.
Okay. Slightly better returns potentially with bonds. What if you want a bit more growth potential, but maybe you don't have the time or expertise to pick individual stocks?
That's the perfect entry point for mutual funds. Think of it like hiring a professional chef, or rather a team of chefs, to manage your investment portfolio.
I like that analogy.
Yeah, your money gets pooled with others, and a professional fund manager invests it across a diverse range of assets, spreading the risks.
What kinds of mutual funds should people know about?
There are a few key types. Equity funds mainly invest in stocks. They aim for long-term wealth creation, potentially offering, say, 12-15% returns per year over 10-plus years, but they come with higher risk.
Okay, higher risk, higher potential return.
Then you have debt funds. They invest in things like bonds, aiming for steady income and preserving your capital. Returns are typically lower, maybe in the 7-9% range.
More stable.
Exactly. Hybrid funds mix both equity and debt, trying to balance growth and stability. And one type that's become really popular, and our sources highlight this, are index funds.
Index funds.
Yeah, these are low-cost funds that simply try to mirror a market index, like the Nifty 50. They don't try to beat the market, just match it. And interestingly, over the long run, many actively managed funds actually struggle to consistently beat these simple index funds. So it's a surprisingly effective, low-effort strategy.
Low cost matches the market. Sounds appealing. And how do people actually invest in these?
The best way for most people, especially starting out, is through a systematic investment plan, or SIP.
Right, SIP.
You can often start with as little as €500 a month. It automates the investing, takes the emotion out of it, and lets you benefit from something called rupee cost averaging, and, crucially, compounding over time.
That consistent, small investment.
Okay, so mutual funds offer diversification. What about taking a more direct approach? Like picking individual stocks.
Ah, yes, direct equity.
Yeah.
This is where you become the chef yourself, essentially. It definitely offers the potential for higher returns than mutual funds, maybe significantly higher. But, and this is a big but, it requires more knowledge, more time for research, and frankly, stronger nerves to handle the ups and downs of the market.
So not for the faint-hearted or the uninformed.
Precisely. If you do venture into stocks, there are some golden rules our sources emphasize. First, diversification is still key. Don't put all your money in just 1 or 2 companies.
Right.
Second, only invest money you can genuinely afford to lose, especially in the short term. Third, think long term. We're talking 5 years minimum, ideally longer.
Patience is crucial. Absolutely. And finally, do your homework. Understand the business you're investing in, its financials, its industry. It's about making informed choices, not just guessing or following tips.
Informed choices. That sounds like a good segue.
Yeah.
Are there specific investment options that also help with saving taxes?
Yes, definitely. 2 really popular ones in India are the Public Provident Fund, PPF, and ELSS mutual funds.
Okay, tell us about PPF first.
PPF is a government-backed scheme. It has a long lock-in period, 15 years, which kind of forces you to save long-term, mainly for retirement. The interest rate is set by the government, currently around 7.1%, and the big plus is that the interest earned and the final amount are completely tax-free.
Tax-free is always nice. And ELSS.
ELSS stands for Equity Linked Savings Scheme. These are basically equity mutual funds, but they come with a tax benefit under Section 80C of the Income Tax Act. They have a much shorter lock-in period than PPF, just 3 years.
3 years versus 15.
Right. And because they invest in equities, they have the potential for higher returns than PPF, but also carry higher risk. So it's a trade-off between lock-in, risk, and potential return, plus the tax saving.
Got it. What about the traditional Indian favorite real estate?
Ah, good old real estate. It definitely has a strong appeal for long-term wealth creation in India. Owning property feels tangible, but the practical side, well, it usually requires a very large investment up front. Transaction costs like stamp duty and registration are high. And property isn't liquid. You can't easily sell a small part of it if you need cash quickly.
True, it's a big commitment.
For people who want some exposure to real estate but maybe don't have the huge capital or want more flexibility, there's an alternative. REITs. Real estate investment trusts. They're traded on stock exchanges like shares. They own and operate income-generating properties, office buildings, malls, warehouses. So you can invest smaller amounts, get dividends from the rental income, and buy or sell them much more easily than physical property.
Interesting, like a mutual fund for property.
Kind of, yeah. Okay, we've covered a lot of ground: budgeting, emergency funds, different investment types. But what ties it all together? What makes the real magic happen over time?
Is this where we talk about compounding, the eighth wonder?
Exactly that. Albert Einstein supposedly called compound interest the eighth wonder of the world. And for good reason. Let's use a simple but powerful example from the sources.
Okay, let's hear it.
Imagine 2 investors. Let's call them Arjun and Sneha. Arjun starts investing 5,000 euros every month when he's 25. He keeps doing this for 10 years until he's 35, and then he stops investing completely. His total investment, 6 lakhs? 5,000 by 12 months by 10 years.
Okay, 10 years of investing, then stops.
Now Sneha. She starts later, at age 35. She also invests 5,000 a month, but she continues investing all the way until she's 60. That's 25 years of consistent investing. Her total investment, 15 lakhs. 5,000 by 12 by 25. So she invested 2.5 times more money than Arjun.
Right, invested much more for longer.
Now let's assume both their investments grew at an average of 12% per year. Who do you think has more money when they both reach age 60?
Sneha invested way more. But Arjun started earlier. I'm guessing Arjun.
You got it. Arjun, who stopped investing at 35 after putting in only 6 lakhs, ends up with roughly 1.37 crores at age 60.
Wow.
Sneha, despite investing 15 lakhs over 25 years, ends up with about 1.06 crores.
That's actually staggering. He invested less than half as much, but ended up with significantly more just because he started earlier.
Isn't it incredible? That's the raw power of compounding when combined with time. It just blows simple interest out of the water. The key takeaway is crystal clear. Time is your single most valuable asset when it comes to investing. The cost of delaying, even by a few years, is absolutely massive. Start now. Even if it's just 500 euro a month, start now.
That example really drives it home. Okay, so the potential is huge, but it's probably not always smooth sailing.
Yeah.
What are some common mistakes people make that we should try to avoid?
Oh, absolutely. Knowing the pitfalls is just as important as knowing the opportunities. Let's cover a few common ones. First, analysis paralysis. Getting stuck researching endlessly, looking for that perfect investment, while your money just sits there losing value to inflation. Sometimes done is better than perfect. Just get started.
Yeah, perfectionism can be costly here.
Definitely. Second, following random tips. You know, your neighbor mentions a stock or you see something on a WhatsApp group that is not sound investment advice. Do your own research or consult a qualified advisor.
Resist the urge. Got it.
Third, emotional investing. This is a big one. Buying stocks when the market is soaring because of FOMO, fear of missing out, or panic selling when the market dips. You need a plan, and you need to stick to it through the ups and downs.
Keep calm and carry on investing.
Pretty much. Fourth, not having clear goals. Why are you investing? Is it for a house down payment in 5 years, retirement in 30 years, your child's education? Knowing your goal helps determine the right investment strategy and timeline.
Purpose drives strategy. Makes sense.
Fifth, and this is fundamental, ignoring insurance. People sometimes confuse insurance and investment. They are different. Insurance is about protection. You absolutely need adequate life insurance, maybe 10, 15 times your annual income, and good health insurance before you start serious investing.
Protect your foundation first.
Protection first, then growth. Crucial.
And finally, putting all your eggs in one basket. We talked about diversification earlier. Spreading your money across different asset classes, equity, debt, maybe a little gold or real estate via REITs, is your best defense against unexpected shocks in one particular area.
Don't bet the farm on one thing.
Yeah.
Okay, those are really practical warnings. So we know the potential, we know the pitfalls. How does someone listening right now actually start? What's the action plan? Right, let's make it super practical. Here's a phased approach anyone can follow. Week 1. Foundation. First step. Just track your expenses. For 1 week, note down where every rupee goes. Use an app, a notebook, whatever works. Also, if you don't have one, open a basic savings account. And critically, check your insurance. Do you have basic life and health cover? If not, start researching that now.
Okay, track, save, insure. Week 1.
Week 2. Setup. Look at your expense tracking. Now, create your budget using that 50-30-20 rule, or maybe the 40-20-40 if it applies. Next, open a DMAT account. That's where your shares and mutual funds will be held electronically. Choose a discount broker. They usually have lower fees. And download a couple of investment apps like Zerodha's Kite or Coin or Grow, just to get familiar.
Budget, DMAT account, apps. Week 2.
Week 3, start small, time for action. Set up your very first SIP, maybe just €1,000 a month into a decent large cap equity fund or an index fund. Just start the habit. Also, start putting a small amount towards your emergency fund, maybe €2,000 a month to begin with, and open a PPF account. It's easy to do online or at the post office bank.
First SIP, emergency fund savings, PPF. Week 3, concrete steps.
Month 2 onwards. Build momentum. Now you're rolling. The key is consistency. As you get comfortable, maybe increase your SIP amount. Start thinking about adding another fund for diversification. Keep learning, read articles, watch videos, and review your plan maybe once or twice a year. Adjust it as your income or goals change.
That sounds really manageable, broken down like that. Are there specific tools or resources people can use?
Yeah, absolutely. For expense tracking, apps like MoneyView or Walnut are quite popular and easy to use.
Okay.
For investing platforms, as I mentioned, Grow, Zerodha with Kite for trading and Coin for mutual funds are widely used and pretty user-friendly.
Right.
And for learning, Zerodha's Varsity is fantastic. It's like an online textbook, really comprehensive and free. Also, there are some great YouTube channels like CA Richana Renaud that explain concepts clearly.
Brilliant. Lots of resources out there. Okay, as we start to wrap this up, what's the main message we want people to take away from this deep dive?
I think the core message is that personal finance is truly, well, personal. There's no single right answer for everyone. What works for your friend might not be right for you. The most important thing is to start with the basics we've discussed, be consistent, don't be afraid to start small, and just commit to learning as you go. Adjust your sails along the way.
Start, stay consistent, keep learning.
Got it. Maybe we can quickly recap the absolute key takeaways.
Sure, let's boil it down. 1, start now. Seriously, even if it's a tiny amount, time is your biggest advantage.
Number 1, start now.
2, emergency fund first. Build that safety net before you dive deep into investments. Protection first.
Got it. Safety first.
3, diversify.
Yeah.
Spread your investments. Don't put all your faith in one stock or one fund.
Spread the risk.
4, remember, time in the market is more important than timing the market. Don't try to guess the peaks and troughs. Just stay invested for the long haul.
Stay consistent.
5, and finally, automate. Set up those SIPs, automate transfers to your savings. Make it easy to be consistent.
Automate for success. Those are great takeaways. And maybe one final thought to leave everyone with. It's that old saying, the best time to plant a tree was 20 years ago. The second best time is now. So just consider, what's one small, consistent action you can take, maybe even today, that your future self will thank you for? Your whole financial journey really does begin with just that first step.
That's a powerful note to end on. Thank your future self.
Yeah.
Brilliant. Thank you so much for sharing all these insights. And thank you all for joining us on this deep dive. We really hope this empowers you to take that first step or the next step on your own financial journey.